Well, hello everyone and welcome to this TradeStation webinar event. A very special event this afternoon. We're going to discuss the Elliott Wave theory with Corey Rosenbloom, one of our favorite commentators on this topic. Since the 1930s, traders have used the Elliott Wave theory to analyze market cycles and forecast trends by identifying extremes in investor psychology, price highs and price lows, and other factors. However, this controversial technical analysis technique really comes down to three hard rules. If we learn them, we'll have taken the first step to incorporating Elliott's principles into your trading. So, today, Corey Rosenbloom, the founder of AfraidToTrade.com, is going to explain to us is going to describe the Elliott Wave theory and explain in detail in this must-see webinar for all of us that want to be technical analysts. I'm very excited about our presentation today. But before we actually turn things over to Corey, we need to go through our disclaimer information. The following presentation is for educational purposes only. All the symbols and trading ideas that our instructor talks about are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in a jurisdiction where TradeStation is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. I've posted in the chat panel a couple of pieces of disclosure information in PDF handout format. You can download those and read them at your leisure if you so choose. I also have posted the calendar of upcoming TradeStation webcast events and a link to our archive site for older TradeStation events. Now, if you the question will come up, are we recording today? And we certainly are recording. I will make I'll give you the link to our YouTube channel. It is in the chat panel already, but we'll put it in here one more time. I'm sure that we'll get some requests for that. By the end of business tomorrow, this presentation should be in place on our YouTube channel and on Video Station if you are a TradeStation user. One more piece of business, the chat panel is privatized today, so your questions will be reviewed by Corey in the order that they come in, and he'll be able to interact with you. You may not see anyone else's questions. That's the whole point. So where are you, Corey? Corey, let's take her away.
All right. Hey, everybody. How's everybody doing? Thank you, Don. It is good to be with you today. It feels weird because I'm here in Los Angeles. I normally give the briefing at 6 a.m. my time, so it is 1:34. So I feel like I should be taking some coffee. Anyway, greetings and welcome. Just taking a look at Amazon and Apple and the Dow Jones and some other factors we'll go through for today's session and beyond. But just what's Apple doing? What's the divergences? What are divergences? What's momentum? And how do you combine all these factors together to, I hate to use the word forecast, but plan, that's a better word, plan your trading day, plan your trading week if you're a swing trader or maybe even an investor. So these things look really bullish, and they are from a price perspective, but pull back the perspective, pull back the headline, pull back all the charts, look beneath it to momentum, to volume, and these little things called Elliott waves. So if you are familiar, go ahead and you might not see them, but I'll be able to see your chat. I do want to make it interactive, so I don't just want to talk to the computer screen for the hours. Please, there we go, as I come in, so take myself on mute. But if you do have a question, again, put that in the chat box, comments as we go through, so we'll make it interactive. Before we get started, go ahead to the PowerPoint. So just a yes or no, have you used Elliott in your trading? So how many people here in the presentation have used Elliott? Maro says no, capital letters no. Michael says no. This should be fun. Wes says no. Robert says no. Senator says no. Never. No, no, no. Okay, Tim says yes. Okay, cool. Tim says yes. Gene says no. Andy says no. Well, good. This is exactly why I wanted to ask the question. Because I want to give a live presentation I can see the audience, I can see your hands, I can see your attention level. On a webinar, I can't. So obviously we want to be as interactive and keep your attention, and my attention here too, as long as we possibly can, and impart this knowledge. So a lot of people have not used Elliott, and Pamela says, I follow Jeffrey Kennedy, but not yet. And that's fine, that's fine. I'll be honest, I'll kind of jump it off like this. This is my, started 2009 as a trader. As a full-time trader, 2007. Started in 1999, actually, as an investor. So that's sort of, obviously, Don talked about the risk, but here's sort of my background really quickly. Began in 1999, became a swing trader in 2003. And the more I learned about technical analysis or charting, I focused on indicators, strategies, and those sort of things, mostly through stockcharts.com and eventually to TradeStation. I became a TradeStation client and used them really full stop from 2005 forward. So I'm a long-term TradeStation user. And obviously, it's my favorite platform and all that. So, and an honor to be part of the TradeStation group and give the briefings and be associated with a lot of people that work at TradeStation. So they're like my family. So it's just an honor to be here with you all and the TradeStation group. So, long-term user. But when I got into Elliott, Corey being honest here, I thought it was the stupidest thing in the world. Count to 5, make some money. Look at a third wave. What's this? What's that? I just didn't see any point in it. And probably you don't either, and that's fine. And the presentation, though it focuses on Elliott, certainly, is going to cover a lot more territory in terms of Dow theory and cycles and volume indication, how to sort of make a forecast based on that. So, keep with me here. But I did think it was not appropriate. A day trader, yeah. Pam says, why to go to a day trader? Because I finished grad school real quick. So real quick on my timeline here, this is obviously a very, 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 very brief timeline. So when I went to swing trading, I was in graduate school, college, had an investment group, was working with my dad, was working with other people, and I finished grad school, got my master's in public affairs. Did a little time in Washington, D.C. in 2004 in the election. That was fun. Talk about that later maybe. But when I finished my grad program, I was going to take a year off and travel, have some fun. But I started trading. I've been trading with my dad and some other friends at college for really from 2003 forward. I don't call myself an investor. Now I'm more of a trader. But back then I was in the market. So the market's been part of me for a very, very long time in my experiences. But when you go full time, you're sitting there making swing trades, and you've got the computer screens, you've got your news feeds and all that, and CNBC and everything else, Twitter at this point now, StockTwits. And it just didn't make sense for me to make a couple of trades a week, maybe a couple trades here and there. So day trading was a natural outburst or natural progression from being full-time. Doesn't mean you have to do that, but to me it was a way to manage risk better. I was attending market traders expos and was meeting with other traders and fellow enthusiasts, and I actually had mentorship by 2 other people at that point in time, and they were like, go intraday. And so that's personal story here. That's what I did, and that worked a lot. And I actually started going full time when the market was peaking. And so when the market went down in 2008, that was my best year ever, really to this date, because I was short in the market, quite aggressive on the day trading front. Plus, I was younger, was less knowledgeable, was more risk-seeking, and was having a lot more fun, which is not something you do as a professional. There's a difference in having fun and speculating and going wild with trading and being a professional for a career. And so once I made that, built up a nice war chest, I began to be more serious about my education. So that's what brings us to Elliott. And so I got involved with the CMT material. It's a charter market technician. It's kind of really a grad school program on top of grad school, for me at least. We had a team we worked with back, from, if you can hear my accent, from Huntsville, Alabama. And we had a team, we'd meet 3 nights a week. And we'd go over the classes. We had to read these enormous textbooks from Pring and Murphy, and the Elliott Wave Principle is part of the material. Cycles from Hurst, and what else? Dow, obviously. Connie Brown, indicators, also use Elliott. All sort of things. Bukowski patterns. I mean, the list goes on. And I highly recommend that program if you are going to be a serious professional full-time trader. There's a lot of ways to learn. My material, TradeStation has a plethora of material to go through as well. But to be a formalized A to B to C to D progression, the CMT was great for that because it made you do things you, or me, do things I would not normally do. For example, study Elliott Wave, study cycles, study Fibonacci. What's this Fibonacci thing? What's this Elliott thing? It doesn't make sense. But to pass a test, I have to know it. And so I am going to take it seriously. I'm going to learn it, even though I may never use it. And to be honest, I did the same thing with point and figure. Studied point and figure charts, never have used them since. Never probably will. So just keep that in mind. As you go through your trading journey, you might be a short-term trader, you might be a swing trader, might be a long-term investor, might be an active day trader. So this presentation is really designed for you, no matter what you're doing. Just apply the lessons to your particular market. So Pam's asking about beans or wheat or corn. What I do personally is trade. I specialize in the ES, which is the E-mini for the S&P 500. That's my specialist market. Beyond that is the Dow Mini. So I kind of go back and forth on those. I will trade gold and I will trade oil. That's all I do in terms of futures. I don't go beyond those. I just don't have the patience, and it's not so much a skill set. It's just that's what I've focused on: the gold, oil, and Dow and S&P. In terms of futures contracts, I will also trade leading ETFs and leading stocks, more of a swing basis. I used to be a full-time intraday trader of leading stocks, and that just became hyper. So as you get older and more mature and more professional with your material, you do typically specialize. And so the presentation here in Elliott and anything else in general is going to work for lower time frames for stocks. We'll take a look at stocks. But I, Corey, specialize in the index futures for the majority of what I do as an intraday personal trader. But again, I do use sector rotation, and I use leading stocks and ETFs. And those will be for a different portfolio, a different account that I use swing trading, because I have a longer term retirement account, but that's neither here nor there. You can actually do different things, but I do, if you are mixing day and swing, I do recommend having multiple accounts, and that's not really difficult. Even if it's just a simple stock account just for day trades, a simple stock account just for swing trades. So as we go through, that's definitely possible. Moved to Los Angeles, going on just about 4 years now, and it's a big difference, big world, love LA. The picture here is from Santa Monica, and I, along the way, was fortunate to be asked to write a couple of books with Wiley Finance, Wiley Trading. The first is a complete trading course. The Elliott principles we'll talk about here are detailed further in the book. Trend continuity, momentum, and of course Fibonacci, all those sort of things, and trade setups. This is sort of a mini crash course. So I don't discuss Elliott in terms of strategies publicly much, so it's sort of fortunate to be doing so today, so I'm excited about this, but it will be a fast, top level, put it in context, and get the bigger picture on Elliott. So I'm not going to go down to deep levels of the third wave and this and that. I'm going to keep it simple and keep it fun. So, and again, I'm honored and really have fun with this market briefing. We do that every other Tuesday with TradeStation, and that's a lot of fun. So we'll go into it on that. The book is not on video. I do have some video courses and video YouTube. We'll talk about those as the progression or presentation goes on. So as you're doing your trades, your method, your strategies, your short term, your day, your swing, etc., I want you to focus on these 3 setups. At the mentorship program, the classes that I teach, and the traders that I coach, I always bring it back to this: simplicity, simple methods, foundation. What are you doing? In other words, what trade are you setting up? What's the expectation? And thus that tells you how to enter, how to position yourself, how to manage your stops, wide stops, small stops, or tight stops, large target, small target, and how to engage the market if something goes wrong. Do you hold on, or do you go ahead and kill the trade right then, right there? And each of these setups has specific parameters. Retracements are my personal bread and butter. If you work with me or look at my material, I will focus the majority of what I do as a private professional trader here as a retracement type methodology. That means I look for trends. I look for trends in motion. Elliott Wave is helpful for that. Volume and other factors are very helpful in determining the odds of a trend continuing or reversing. We'll go over that shortly. Breakouts typically in the direction of a trend, those do allow you to play for larger targets. I don't think you become super, super wealthy being a retracement only trader. You need something else in your toolbox. For me, that's breakouts. They allow you to play even options. People that like to trade options, breakout strategies or range expansion or range breakout techniques are really helpful for option or volatility trading. So keep that in mind too. It does have a little bit lower success rate than the core retracements, but it does make more money on balance. Reversals, oh boy, so controversial. We'll kind of go through that as a presentation goes on, but Elliott Wave is part of all three of them, especially reversal style trading. If you are a trader, and that's fine, who does like reversals, I'm not one of them, used to be, but as a professional person now, 17 years in the business, I'm not. I look for simplicity, I look for ease of efficiency, ease of movement, get me in, let the potential profit occur quickly, and get me out. I don't want to sit here and babysit a position and hope it goes well and go through things like this where you think this is the fifth wave and that's the top of the market. You get short, you get 2 weeks or 2 days or 2 hours or whatever of good action and profit, and the thing just goes, stabs you right in the eye with a new high. Ugh, it's not fun for me whatsoever. But then, of course, you're ultimately right in the position, and the market reverses. This was the case in 2007 at the market top, and just many, many, many examples where you think the market's done, you think it's not going to go down or up anymore, you put your position on, and darn it, there it goes. So there's a lot of ways to look into that and to enhance your reversal strategies. Elliott is one of the things that's helped me do that beyond most other components. So let's jump into it. So Elliott just simply asked the question, where are we and where are we going? If you've done any type of market profile, Stottlemyre and Jim Dalton, etc., any time of work with that, they ask a simple question with price and volume. What's the market trying to do and how well is it doing it? So if the market's trying to keep going up, trying to make higher highs and higher lows and remain strong in a bullish uptrend, you should look to the second question, how well is it doing it? With volume, if volume is confirming, if it's making higher highs, you see a bullish trend in volume and a bullish trend in momentum. If you're trading index futures, a bullish trend in market internals such as breadth and tick, that's good. The market's going up and doing it well. Therefore, it probably will continue. If you see a market going higher, but divergence is set in those internals and momentum and volume and all the other factors, it's not a good sign. So it's going up, but it's not doing so very well. Might reverse. So stop trading your retracements. Look to trade the other side when the market actually gives confirmation and starts to fall. Elliott can help with that. Now, as we go through, a lot of us have not used Elliott, so I'll sort of give you the simple treatment. Well, that's what I do anyway with my classes. I keep it simple because that's how it works. There's no need to be complex. So focus on the 5-wave progression. Makes a little movement here. Learn the logic, which we go into, and I'll ground that with you in terms of Dow and Elliott and Schabacker and the others, Pring even and Murphy. So the logic behind what's going on. And Don hinted at that at the start of the presentation when he mentioned there's extremes in psychology when the public is really, really bearish and disgusted and just horrified by a stock. Snapchat comes to mind, or other names, make Chipotle, for example. That tends to be the bottom of a market in general. Now, on the opposite side, when the market is when the traders, most traders, are extraordinarily bullish and just got to get in the stock market, they got to start leveraging things and mortgaging their house to buy shares of stocks. That's typically a top. As a kind of person going from the private world to the non-professional hobbyist to a professional trader, that was one thing that made me so, I wouldn't say angry, but it confused me. Because why is it that way? Why do people get it wrong so much? Why can't people just be right? Why can't it all be simple? And it's not. And we'll discuss why that is. But Elliott, once again, does help with the logic behind what's going on. It's a difference between professionals and, I wouldn't say amateurs, hobbyists, people doing this for fun, people lured by the profits, how much money you can make. So that's kind of, we'll go into that, the difference between those. And the difference in impulse and correction. I work with the hedge fund guy that does Forex, and we talk about, he's mostly into Elliott and Fibonacci. And so he's very, very detailed in what he does and his fund and how they do their positioning and management. But one thing he taught me years and years ago was that you need to learn the difference between an impulsive wave, or one that's going in the direction of the trend or making movement, like wave 3, the green one essentially, and one that is not. So if you're in a corrective wave, define that. Don't get aggressive. Don't get active and trade left and right and get, stopped out both directions, long, short, losing money both ways. Only wait for impulsive waves to take place. Learn the difference, and you don't even have to count the waves. It's just learn the difference in an impulsive and corrective period in the market. And again, big picture, not the little weeds. So let's go to Dow theory. Elliott off the table. No more Elliott for 5 minutes here. So Dow comes along early 1900s and finds out that in his world, without computers and without plentiful textbooks on the subject, that the market typically exhibits 3 phases. He called them an initial accumulation phase, the start of a movement, a realization phase where the market's going up, and typically a sideways or distribution phase. That's really it. That's Dow theory in a very, very simplified nutshell. Start, middle, end. Accumulation, realization, distribution. And so these are the phases as taking place in an actual stock here. So start, middle, end. Accumulation, which is typically a sideways, typically a V or a U shape. Realization, which kind of is like a sideways 45-degree angle. And distribution is also a V shape, or maybe even an upside down U, or we call it a rounded reversal. So that's basically Mr. Dow. And then the other way, also Richard Wyckoff came along, and this, just think about outside the box here. Richard Wyckoff came along and saw this, the same thing, and he said, oh, okay, well, gotcha, Mr. Dow, but I see this as a mark up phase. This here is a mark down phase. And he added a lot of parameters, including sign of strength, sign of weakness, last point of supply, last point of demand, jump across the creek, and all these fantastic terms that we use for Wyckoff. But he just added a couple more phases to what Dow said. Now, what did Elliott do? He just added the same thing, saw the same thing, and added waves. So he just said 1, 2, 3, 4, 5. And so that's pretty much Elliott Wave. That's as simple as it gets. But trust me when I say that's all you need to know to go off and start identifying these structures. It's the middle characteristics of accumulation, Dow theory and Wyckoff, and Elliott, obviously. Realization, which is where the retail traders or the novice traders are buying with the professional traders. At the top, you have retail traders getting really, really bullish, with the professionals, who they bought down here, by the way, they're taking the profits, maybe even getting short. So you do have a discrepancy, as we'll go through shortly. But anyway, so think of it like a life cycle. I have a book on this one too. From birth to infancy to teenager, young adult, where it's rebellious and talking back to the parents, adult phase, elderly, and eventually the top. So this is the same little concept of start, middle, end, accumulation, realization, distribution, and we'll be adding other factors to help us determine what is going on. So not just price itself. So I use a momentum oscillator from my mentor, Linda Raschke. It's the 310 MACD. It's just a simple moving, basically it's a MACD, but parameters 3 and 10, not 10 or 12, 26, 9. So it's basically change that to 3 and 10, and that becomes a momentum oscillator. Also can use rate of change, or just the TradeStation has it itself, an indicator called momentum. And nothing special about it necessarily. A volume is the same. So at a top or ending terminal distribution phase, you need to look for divergences, especially in volume, that supply is coming in or the buyers are becoming less powerful, and in momentum. And eventually the peak, new momentum lows, and a surge in bearish volume. That's your markdown. So this kind of making it formal. You want to see a flat U-shape, flat rising volume, and it's basically professionals like Warren Buffett and Carl Icahn and other people like that that are buying for the long term when the market's going down. Other traders are freaking out and panicking. So you have the large majority selling or avoiding, and then small minority buying. Turns out the minority has more money than the majority. And two is where they're both in there, both buying. Professionals either buying, adding to existing positions, or just holding them for fundamental reasons. And small traders are kind of dipping their toe in the water, not quite really bullish, but they're getting into a market. As it rises, they make money. So we do breakouts and basing moves and patterns and rounded reversals. So we'll talk about that, how you can get in that spot as early as possible. And the flip side is distribution. Small traders, unfortunately, think it's going to go up forever, and it doesn't. So again, the majority is bullish, buying or on margin or leveraging out things. You get spiky behavior, volatile behavior. Price tends to jump around and gap around a lot, and that hasn't happened in the realization phase. And you also get divergences. In different presentations in my own practice as a swing trader, will engage realization, and I highly encourage you all to do so as well. I don't think we do well, I'm just going to Corey speaking, but I don't think people do well trying to get the bottom in accumulation that can last longer than you think. And I don't think buyers or sellers do very well in distribution because of the choppiness, the gap. Up there's the top. Oh, just kidding. Up there's the top. Get really, really short. Up there's the, it just doesn't really work. I let the market fall, let it break some trend lines, let it break some moving averages, let price do other things than trying to be that hero that nails that top or catches that falling knife at the low. So Chipotle, a few years back, accumulation, breakout, strong volume, strong momentum, all the way up here, massive euphoria, up, weeks in a row here. And strangely enough, divergences. Look at that volume divergence. That's something you should really pay close attention to. 2012 Chipotle weekly. Go back and reference that. How this up, nonstop. She's going to go up forever. Chipotle is the best stock in the world. It's going to be the best thing ever. And it collapsed, really knocked its value in half in a few months after that happened. This is the way the market works for the most part, especially in the bigger picture. So accumulation, realization, distribution. Elliott, and just make sure we get those concepts. Elliott comes along at the same time, 1920s, 30s, and begins to write his Elliott Wave Principle. And so I recommend if you are interested in the topic, read the book. If not, this could be a substitute for it. But nonetheless, he just says the same thing: accumulation, realization, distribution, or 1, 2, accumulation. Big 3, 4, 5 is realization. Up to the 5AB is your distribution, and Wyckoff calls it markdown. Anyway, that's your idealized Elliott cycle. Now, halfway point. These are the rules not to do. So get a pencil, write these down. Do not do these with Elliott Wave. Don't get overwhelmed. And when I first learned Elliott, I thought it was horrific and terrible and stupid. But as I learned it and I started seeing it and trying to apply it for the test, it made a lot of sense. And it just dovetailed really nicely with the trading I was doing already, which is basically trend-style trading and divergences, things like that. It just went right alongside of it. So I began to be more interested and study it more, and I obviously use it about 10 years later, still do. Don't call myself an Elliottician, but one who does use the founding fathers, founding technical analysts, to devise my own trades from that foundation. So don't get overwhelmed. Don't count all these little detailed things. It's not worth it. Don't fixate. So if you think you have a wave count and you've done it, for 2 hours, you got this perfect count, and the next thing you know, a couple of days later, the market invalidates that count. Whoops. Don't do that. Just keep an open mind and get the bigger picture, like Don said. What's the broader market flow? What's the professionals doing? What's the amateurs or the new traders doing? And what's the extremes in psychology? Are there extremes in psychology? If there's not extremes in psychology, chances are that trend is going to continue. So don't fixate on a wave count. Don't get frustrated when your wave count fails, which is kind of funny. I had a good friend with the CMT back in Huntsville. We did our work together, and he went to a private mentor that was specialized in Elliott Fibonacci. I won't say the name, obviously, but when he was assigned an Elliott Wave pamphlet or Elliott Wave example for that night to go back the next day and to present it to the mentor. And he did so. He spent probably 2 or 3 hours on Elliott, was excited about it, and presented to the mentor. And the mentor basically looked at it, looked at him, threw it down on the desk, and said, "Don't you ever do Elliott again." What? He was heartbroken. But I don't know if it was so bad, his count, or just so inaccurate, or just was a power play. Who knows? But it really frustrated him. But I've also thought that was a funny story. Just don't get frustrated. So don't make it personal. Don't make it about, yeah, so that's Don posted a link to the quick cheat sheets there. So absolutely. So don't get frustrated. Don't use an isolation. And your own Elliott wave count is part of something else. So it's not just your count. Don't use it just by looking at the price. Don't look at this and say, oh, it's the fifth wave because this looks like a fifth wave. Again, use volume, momentum, internals on the indexes. Other things else, if you're using fundamentals like corn, grain, other markets, or Forex, doesn't have volume, look to other factors. Don't just say Elliott. And don't expect perfection. There's a good joke in the Elliott Wave community, and I agree with it. I've seen it happen plenty of times, where you count for a fifth wave. So here's the joke: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's what's happening really in the S&P right now. People have been calling for a fifth wave for a while, and it hasn't happened. Even last year, it didn't happen. That's the big joke. Fifth waves can become really, really extended. But just don't fight the trend. So here's your ideal structure. Again, don't put the education link. So let's look at that one. This is the one that my hedge fund guy was talking about that really helped me when I was learning this. Don't worry about the big picture. Focus on the difference in an impulse or a correction. And Linda Raschke, when she was discussing not so much this concept, but movement and corrections and those sort of movements and how you get into retracement trades, she would talk about price bar overlap. Or what that means is when a price is going down, in this case, you can see that it's overlapping and almost draw trend lines in here. Let me sort of do that real quick. At this point, you can really draw your overlap. So that right there, up, down, that's overlapping. It's overlapping both itself in this box, but it's also overlapping back here. That's called price bar overlap. You don't want to see that if you're thinking you're in an impulsive wave. That's the difference for the most part in, there we are, in a correction. An impulse doesn't have that. An impulse is movement, it's motion, it's covering ground quickly, impulsively is the word they use. So that's the difference in an impulsive wave. Buy it, get into it, trade the retracements, trade the breakouts, and await for an end to a pullback or a corrective wave. So that's your impulsive, there's your corrective right here. So don't worry about this. Just worry about what's called price bar overlap with respect to corrective waves. Why do we care about this? Because we want to buy pullbacks when a correction is done. We want to get into a trending market. How do we do it? When a correction is ending. That can be, for the most part, a little drawing tool here, when, like a flag, right? This is a bull flag going up here. Either enter when you think the market's gone down, hit a Fibonacci level, something else has happened, or the market breaks out of the trend line. You really get two trades. Trade one is an aggressive maneuver, Trade 2 is a more conservative maneuver, and that's just off a zigzag, flat and triangle. You know what a triangle is. Same thing. Get in when it breaks out, above or beneath. So a flat is just like a rectangle. So your core little patterns, rectangles, buy above here, buy or short sell under there, so on and so forth. So again, why do we care about the difference? Because it's very important. It's important because that's how we get our trades on. It's how we manage our positions and how we play our stop losses. So this is, for the most part, an ideal Elliott count. I'll kind of pause for questions here before we go to the next part. But any general questions? Covered a lot of ground so far. Let's have a moment for questions and digest a little bit here. Anything at the moment? As you look at this perfect little picture here. Yeah, definitely. Yeah, I'll keep going. Yeah, no problem. Okay, cool. So question, yeah, no official questions. I keep going. Okay, everybody's like, keep going. All right, sweet. So as we go through, one little secret, were those all, yeah, a question, were these all corrective waves? Yes. So again, this is weeds. This right here is weeds. Don't worry about this. If you want to get deep with Elliott, this is what you do, but the main idea is that it's correcting. There are little specific definitions. There are 4 different corrections. Don't worry about that. Just worry about that it's correcting. In other words, that there are, and Joseph asked, can you explain price bar overlap? Yeah, price bar overlap is just a concept where, think about like a rectangle, and I'll sort of draw this. This is like a flag. If you heard the term bull flag, this is a flag. So what's happening is a price bar. These are price bars. This is a daily chart, but they're overlapping. So that's going down. That overlaps these right here. That goes down, and it goes back up and overlaps. So this little thing is called price bar overlap, and it's only just because they're going at the same pace. So it's not making progression. It's actually correcting. And in fact, these little things are internal corrections. They're internal overlap, and this is what's called external. So this right here is going back and touching these little things over here. So this is correcting. This is impulsing. An impulse means it's really at all-time highs or higher highs, higher lows, or the S&P is right now. It's not correcting anything. It's moving. It's impulsing. It's being powerful. It's driving, moving really up quickly. So a correction, this is what's considered maybe a triangle, up, down, up, down, up, but the whole thing's being sideways. So we want to typically emerge or trade a position that comes out of a correction. So I mentioned it earlier. I just think, again, forget Elliott, just talk bull flags, basic TA 101 bull flags. A bull flag, if you go to a Fibonacci level, you can buy at a trend line, buy at a moving average, you can buy at something, and we teach that. Or you can buy on the breakout. So either a buy takes place here or a buy takes place there. But you're waiting until a correction is over. And it might even be better, especially if you're learning this for the first time, to just focus on buying a breakout from a correction, or buying a breakout from a correction. Think of it as like flag, triangle, and then a rectangle. You've heard these words, I hope, in terms of technical analysis. So, flag is up right there, and then up. A triangle is a little consolidation pattern, and a rectangle is kind of a flat, like that. So not to be too complex with it, but that's what you're doing. So don't worry about the count. Just worry about classic textbooks, Wolkowski, Pring, and Murphy, with respect to these little patterns. Ari says, is it good to say for a 1 minute or 5 minute bars? Yeah. The Elliott principle is going to work just as well. I'll say maybe not just as well, but with respect to it, to 5 minutes, 1 minute, if you want to go that low. So without being too detailed on it. So there's a little play up, 1, 2, 3, and that's going to divergence, all that. So I'm not going to get too detailed right now. But as you go through, if you are, and I do this, there's times that I've written out detailed Elliott waves, and we're looking here, the idealized, or not idealized, Dow Jones principle. Yeah, so you can draw these waves in a very low time frame. It gets complicated when you do that, but it's certainly possible. But just, again, don't just look at it in isolation. Put it in context of the divergences and momentum and internals, especially. Okay, so here's the cycles. We're going to go through other questions. I'll get to those in a minute here. Thank you, thank you. So here's a complete cycle. Chipotle is an example I taught a few years back, so I was going to use it again because it was perfect. But here it is. So here's your accumulation. It's a downtrend, 2013. And it's sort of a V spike or a U going on here. Momentum's coming up. Momentum's really strong in the third. Big, big, big up for your third. Pull back 4. And then big up for your 5 with a divergence and new momentum lows. We'll see these in a minute. Again, that's mark down, mark up. That's your Wyckoff and your Dow. These terminologies are Dow and Wyckoff, and that's all they would say. Mark distribution, realization, accumulation. Dow comes along, or Elliott comes along, and says, oh, I see your 3 things, and raise it 5. Beacon 1, 2, 3, 4, 5. So this is a lot of the trading that I do. Yeah, so I can send it to you if you email. The setup for the MACD and TradeStation, Anthony asked, it's a custom indicator, and it's just, for me, I just did it myself. It's your, put the regular MACD, to me, change it for the EMA to an SMA, simple moving average on the TradeStation indicator, and then do 3 and 10. I think default is 12, 26, 9. I don't want to see the 9. I don't want to see the smoothing period. I just want to see the difference in a 3 and 10 period moving average. And that just jumps it up mathematically into this little chart. And I just put color because it looks fun. Trading should be fun. It shouldn't all be just black and white. Add some color to it. But anyway, it's just a difference in a 3 and 10. I'll be happy if you email me at corey@atradethetrade.com. I'll jump that over to you as well. But just even to customize it, it's just the 310 period simple average and your standard MACD with some color added. All right, so if you're looking at, let's go back in time. Let's all put our time traveler suit on here, and let's pretend like a market's in a downtrend, and it's going to go down forever. Never going to go up, ever. Done. So we're right here, essentially, right here. And so the market swings up. Not a big deal. It's a downtrend, right? Lower lows, lower highs. Public is bearish. Professionals see something else. They see maybe fundamentally the stock has gone too low, or the earnings have shifted as CEOs realize his or her mistake, and they're going to make some changes for the future. So whatever reason, they start to buy aggressively. Where the professional or the public is like, this stock's ain't done forever. If you're buying this, you're stupid, that kind of thing. But 2 factors to spot on your chart, independent of Elliott Wave, is this concept of a divergence. I have a whole presentation on that, multiple presentations on that, and a Wyckoff kickoff, or a Wyckoff sign of strength. And it looks like this. When the market's going down, this little thing right here is not special. You look at price, nothing. See, that's not different than anything else over here. However, it does break a trend line. Here's what makes it special. It jumps to a new momentum high. So by definition, a kickoff or burst or sign of strength is that your momentum oscillator is going to, or breadth or internals or volume for that matter, is going to spike to a visual new high when price isn't at a new high. It's a sign of a potential early reversal, and it works best with divergences. And if you want to, obviously in real time, it's difficult to spot these things. But if you are that good and experienced, you can capture potentially the first wave. That's what we're trying to do here. If you don't do that, if you're a regular trader, then the wave 2, which is this right here, the move that's going down, is simply called an I told you so. So if you're the public and you're bearish, you see the market go up, you doubt that's the beginning of a new trend. And so when the market goes back down, you point fingers and say, ha, 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 told you, and you might even short sell that, which is really the correct thing to do. But in hindsight, or looking in real time, it isn't a sell move, and the downtrend has been broken. You don't know that, but in reality, that's your future low. So it's just the first correction in a new trend. It's a very, very difficult spot. The public is still bearish, and they're being rewarded for their bearishness, but the professionals are buying. There's your difference. So the expectation is the market's going to go on and make a new low, but it doesn't. So tell me in the chat box, what happens if people get short and this little red stuff right here? If they're getting short there, they're going to put their stops above the prior high, right? That's what you should do. So tell me what happens in your own words when the market breaks above that high. What do you think? What's going on? Not even the weight structure, just what's happening with the new high. Yeah, Anthony says the stops kick in. RA says they shoot up. Woo. Yeah, shoots up with that. Yeah, and then jumps up new high. Yep, we call it pop stops. Yeah, pop stops. And Tom says the shorts are buying to exit because they just lost money. The short sellers, who may have had the right idea, they are losing money. If the market goes above the prior high, that means nobody got short above the prior high. They are thus in a losing position. So they have to come out. Otherwise, they put their account at risk, and people do that. There's a saying in trading that I emphasize at the briefing as much as I possibly can, that if something should happen but doesn't, it often leads to a larger than expected move in the opposite direction. So forget this stuff in the future, but if this market should go and make a new low, if the downtrend should continue, but it doesn't, in other words, makes a new high, then it often leads to a larger than expected move in the opposite direction. Guess what we call that? We call that wave 3, or as Dow and Schabaker and Wyckoff and the others, Pring and Murphy would call it, realization or markup. So that's what happens here. So this is the third wave. It's the turning point. There is a special trade that I teach. It's called the sweet spot, or the TCZ, trend confirmation zone. It's basically a higher high, higher low, take out the high, put a trade on right there. I may not say it publicly, but it's basically trying to play for a third wave in motion. That's what you're doing. It's called a sweet spot, or TCZ. So that's what we're doing. It's also, this is basically it. Public is not quite as bearish, but they're still skeptical. They're kind of bullish. Professionals are aggressively buying. That's what causes us to shoot up so quickly. They're playing against the crowd here, but when the market is going up and the people are buying it, or the short sellers are buying too, they basically got to get their position on, otherwise they're going to miss it. And it can take weeks, if not months, to put on very large positions for hedge funds and larger accounts like that. So reality, all right, trend reversal. Here we go. Bear's got to go. And so look backward. This is where Elliott comes into me, at least. You might not see this in real time, but when you look backward, you say, darn it, I missed it. Then you can look back in time and say, oh, darn it, there's your 1, there's your 2. You might have been bearish, but hey, it's time to change. If you don't, you're going to lose a lot of money, essentially. So yeah, so that's what we're doing. So look for volume and momentum to confirm. Number 4 is another trade. We'll see it shortly. It is a trade you can take and probably should take. It's basically a third wave pullback. At this point, the market has made higher highs. The EMAs have crossed. You've got momentum coming in. You've got volume coming in, internals coming in, and a really, really big movement. And it just pulls back. So how many times have we been told by the pullback? Wave 4 in the Elliott structure is that pullback we've been waiting for. There's people taking profits. That's fine. And no one's really, really, really bearish. Not at this point, at least. Public is becoming really bullish. Professionals are cautious, holding positions, maybe even starting to rotate out. That's the key. So all right, this is real. Here it goes. This is a bull market for the ages. And so they start to tepidly get in, buy the pullback, and get happy. So what you do, look at this third wave, and Constance Brown talked about this a lot in her book. It's to summarize that, it's the third of third, or this is the heart of the wave, the middle portion, and you can sort of project out the future, not to be too complicated, but then, the third wave is kind of what you're looking for. From there, you can say, oh, it's probably going to make a higher high. That's your trade. That's your pullback. So the final point is up here. When people buy, they're excited. They're buying, but they're not buying from each other because they're all buying, right? The market's got to give some shares somewhere else. They're buying it from the professionals. So the amateurs, the hobbyists, the new traders, brand new people with a promising career, like myself back in the day, like all of us really, we get in at the wrong time and out at the wrong time. And so this is what ultimately happens. The buyers start to buy from the professionals and who are selling, who are liquidating, taking their profits. They think it's going to go up forever, but it doesn't. So the public becomes very bullish. It's a great paradox in trading. Why is psychology this way? Why does it work this way? Why do people get really, really bullish and the market tops? So that's for another day, we can talk about that. But ultimately, it's because of supply demand. And professionals begin to sell, and there's a certain point where, that's why it gets choppy and chaotic, because there's a certain point that the buyers who are really, really, really psychologically bullish don't have any more money. And so if the money stops and everybody's long, the music stops and the market rolls over. So the thought process is, and raise your hand if you thought this, and I'm raising my hand, by the way, I'm right, I'm making money, yay, I'm happy, woo, 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 it's the world's my oyster, etc. I'm going to leverage up. So that's the ultimate thing in a wave 5 as it goes up. Eventually it does end. The reality is it's the top, it's the end of it. It is often, you can kind of do relation to wave 1, don't worry about that so much, worry about divergences. So a question from Arya, if the trend is down, would you then have impulsive waves 1, 2, 3 down? Yes, 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 yes. Let me jump that real quick if I can. On the weekly S&P. So going back, or Apple for that matter. So the question is, does Elliott work in reverse? For the purposes of the presentation, I'm keeping it bullish, but yeah, it certainly does. So here's your S&P on the weekly chart. And this is what got me a lot of money, essentially. I'm not bragging, but back in the day, I learned Elliott in 2006 and 7. I started applying it aggressively in 2000, late 7, 8, 9, and really beyond. So, and this is up on the blog too. It's all documented. I was calling this a 1, this a 2, and it had internal things, a volume, all of the metrics. So I was playing out a 3, and that's a 1, 2, 1, 2, 3. All this stuff right here is a third of third. That's Connie Brown material. This little heart, where it's just so impulsive, is a third wave of a third wave. And that's your 4, that's your 5. And again, not to be too complex with this, but there's your third, and it internally does a big old move there. So I was very aggressive, advocating very, very bearish positions in my blog and membership, and was making a lot of money doing this short selling. And it went further than I even thought it could possibly go. The team I was working with, we were very bearish. We actually were bearish from the top up here. Once again, the market's stabbed you one more time. That's the top, that's the top, that's the top. Oh, just kidding. So we were bearish really going into this point with the financial crisis and housing and debt and all that kind of stuff. And technical analysis. It wasn't just the fundamentals. Technical analysis. The EMAs crossed, lower low, kickoffs, red sell volume, so on and so forth. Anyway, then you get your 4th up to here, and your terminal 5. So back on the blog, I'll show this if I can jump in there real quick. Let's see if we can do it. This one, let's see. On the blog. All right. So this little, this is a blog at afraidtotrade.com. So, yeah, interview with a disciplined investor. So this is where I did this. This is basically Elliott in real time. Right? This is going to connect to Andrew Horowitz's site, the disciplined investor. This was, when was this? What was the actual date on it? Where was this? The top. Well, you can see the date on it. Back to That was April, essentially. Right here, April 2009. So I guess jump in there and look at it. But I'm essentially arguing Elliott Wave. And so what I'm discussing here is that the market has gone through an Elliott progression, and then we're done. That's it. It's over. We're going to go to 1,000, if not above that. And Andrew, good friend of mine, yeah, Elliott count. Here the fifth wave. Look on another chart from Corey. He doesn't post it. And here's the Elliott wave count. Here the fifth wave. The sequence was clear on the March low. This is in real time. This is not me, hindsighting or whatever. I call this the fifth wave, and began to be very, very bullish off of this. And when Andrew and I, this is actually a pretty funny podcast because he's fundamental in terms of he looks at data and earnings and that kind of stuff. None of which were saying the market's done, right? Anyway, and so when he gives his little spiel about how the market's going to crash and go down to horrible lows. When it's my turn to talk, I say we're done. We're going to go up from here indefinitely. And I'd say the look on his face, the sound in his voice, it's listen to the podcast. Anyways, that's how I used Elliott, back in the day. That's another reason why I got so excited about it. Not in isolation, and I'll talk about those too on the podcast because I'm discussing the 310 oscillator, volume, and some internal. I go through more things essentially here. So, April 5th. This was done April 5th, 2009. So, Elliott works. All right, so that's the final point on the distribution. All right, so here's the trades. So let's jump back into this. All right, so this is how to apply it. Here you go. You can't count the waves every time. I can't. Prechter can't. Kennedy can't. No one can. Not possible. Terrible, terrible goal to have. Just look at what the broader picture is and put that in the context. Focus on the setups. Like I mentioned, the flags, the triangles, all those sort of things on these pictures. Use Elliott to guide you, not force you. People do this, and I'm not going to criticize them because if it works for you, do it. I don't think it does. It's just Corey speaking. I don't think you can use Elliott for a standalone. If you can, great, fine. I can't. I don't. So when I went with Andrew's podcast and many others, both before and after and even currently, that I'm still doing Elliott counts, I don't have it in isolation. It's always internals and sentiment and momentum and psychology and volume and da-da-da-da-da. It's everything else that goes with it. There are 4 spots. I'll focus your attention as we kind of conclude on 2 of them. I can't tell you everything. By the way, the other waves, A, B, and C, have their own little characteristics. Ari's asking about A, B, and C. So those are, I couldn't put everything in the presentation. So in a longer presentation and other things I talk about with the clients and the reports and such, I do go into more detail, but just for a summary, we just talk about the 5 progressive or impulsive waves. Yes, it does work in reverse, certainly. All right, so here you go. Third of third. Woo. This is the Connie Brown. I give credit to her for this principle. That when you're looking at the market, we'll go back if we can to our progression here. So in real time, this to me was a countable third of third. And all you have to do is look at this, and that's the beginning of a foundational movement. So that's your 1, 1, 2, 3, 4, 5. 2 is A, B, C, 2, and you're starting to subdivide. 1, 2, and the reason this can't be necessarily a third wave, we'll see the minute here, this cannot be a third because it's a smaller wave. This cannot be a third, therefore it has to be subdividing. Complicated, don't worry about it, but that's how I do that. And when this thing starts happening, you're in a third of third. This becomes distribution. This becomes realization in the opposite direction, and you are essentially, the trend has reversed, selling is occurring, and will probably keep occurring because look at your momentum. That's hideous how low that got, and look at your sell volume. That's horrible. The trend is going to continue. Odds are extraordinarily strong. You get a 4th pullback and a 5th, and that's what occurred. So in real time, what you're doing is finding out a third wave and playing it aggressively, playing it the pullbacks. wait for this ABC fourth and become more aggressive in here. But it's also what we call the sweet spot. So higher high, higher low, take it out, make a higher high on great volume and momentum. That's inherently a trade. And in the S&P, that would have been really here. When you broke 1200, even broke 1300, you start to play into a sweet spot, if not earlier. All right, so the next one. And the other one, kind of hinted at it, it's your C or fourth, or basically the end of the fourth wave, bull flag, triangle, rectangle, whatever winds up happening in the corrective phase. Get in when you think, or hit a trend line or moving average. We talk about retracement trades in different presentations, but the fourth wave after a third, that's a trade. And you can use Fibonacci. This is Fibonacci. So low to high, 38.2. You can buy into your Fibonacci, again, for another day. And then finally, if you are so inclined, and I'm not anymore, just as a personal Corey speaking, you can trade a fifth of fifth. In other words, if you've got a 1, a 2, a 3, a 4, and you can count on a lower time frame, 1, 2, 3, 4, 5, with divergences, take a look at that to short sell. Take your profits. Look for your sentiment, especially if it's really, really, really bullish. You know, that's something that to clue you in. Don said earlier, that's probably a very big danger zone. So at a minimum, if you see this kind of behavior, 1, 2, 3, 4, 5, in real time, we're starting to look at this right now, do not buy this pullback. Don't do it. People do it all the time, and that's fine because it's a pullback in a rising market. But it's maybe not going to work. So anyway, that's your 3 trades. It's your third of third. We call this a sweet spot or a breakout. It's a breakout trade, essentially. There are subsequent retracements that come along. Second one I focus your attention on is the fourth wave pullback to a Fibonacci, to a trend line, to a moving average, etc. And the final one's your fifth of fifth if you are so inclined. If you're not, don't do it. Trade the other retracement, trade the B or something. Don't forget that. So there's your best trades in the cycle. I think I skipped it accidentally, but we have, that's it, here we go. There are 3 hard rules, and we'll finish, of Elliott Wave. Number 1, write these down. Wave 2, if you're counting out what you think might be a structure, Elliott thing, any time frame, and you find out that your 1, 2, your proposed wave 2 goes under wave 1, then that's not a 1. Definition is not a 1. It's probably still in a downtrend, probably going on for a fifth, or it's making a lower low. The downtrend is continuing. What you saw in real time isn't a 1 if the 2 goes under. So basically, it's probably still a fifth at that point. Wave 3 can't be the shortest. That's what got me into the most of the profit zone in 2008, because if you start counting off that thing, wave 3 can't be the shortest. And that's what's getting me into some things now. Has kept me more bullish than other people with the market, which has been correct, because wave 3 can't be the shortest. So if you're counting out a wave 3, 1, 2, 3, in reality, this is probably subdividing. Forget that right now, but it's basically, this is probably a 1, 2, 3 of a third. That's what's happening right now in the stock market, if I can draw your attention there. If you're counting out this as a wave structure, so 1, 2, 3, and people have done this, and it's incorrect. 1, 2, 3, 4, 5. That's wrong. This is not a third wave. It's not. It's impossible. So it is probably, ultimately, of the what my count is at the moment, which is 1, 2, call this primary, 1, 2, coming up for a 3. So this is probably subdividing out for a bigger 3, 4, and then on up. This cannot be a third wave. Not possible. This also cannot be a 2. Anyway, and wave 4, up here, right there, pull it back. Wave 4 cannot go in the price territory of wave 2. That's it. Of all the Elliott principles and the wave and this and that and this and that, if you're proposing a 2, it can't go under a 1. That means the downtrend is continuing or the uptrend is continuing. 3 can't be the shortest. It's probably subdividing into a larger 3, so count that appropriately. And if you're trading out of 4, it's can't go under wave 1 or enter price. Can't go under wave 1 essentially. Those are your rules. The best trades, I'm gonna zoom in on this one, is right here or right there. So if I could, give you advice when you're starting out your Elliott career, if you do want to go further in this, if you don't, that's fine. I thought it was crazy too when I first started doing it. This is really all you get. A break above a prior high with higher volume and higher momentum. That's probably entering a third wave. Buy that breakout. Wonderful. And then once you get a pullback off of that, buy the fourth. If you are so inclined, you can try to play for a fifth. I don't think you should do that though. All right, so if people ask about intraday, and this is today. This is looking at Apple right now. So this got as close as you can get. But look at your kickoff. So we kind of go to the terminology here. So here is a new momentum high or a kickoff when price is not making a new high. It's probably a wave 1. Ultimately, it looks like it was. Wave 2 got as close as you can get, but it also did not do that. And there's your what's called a sweet spot. Buy into the breakout. Otherwise, buy into a couple of retracements. Divergence, divergence, pullback, A, B, C, 4. And we popped up under earnings to probably a fifth or some type of extending fifth that goes even higher. But anyway, that's your Elliott just looking at stuff today. Apple and some other stocks can do that. Pam says real quick, beans or correction appears. I'll take a look at it in a minute there, I guess. Asking about the bean market. Okay, so real quick. So this goes back to the financials, to the lows and the highs. So putting it all into context, 1, 2, 3, 4, 5, 1, kickoff, right? That's the beginning of the bull market. Big old ABC, boom, boom, boom. Breaking out into a sweet spot or a TCZ trend confirmation zone by the breakout. Otherwise, if you don't buy the breakout, that's fine. You have a lot of chances to buy pullbacks in an ongoing third wave that itself diverged, A, B, C, 4, and then there's your little fourth pullback. Nasty pullback, by the way. 1, 2, there's your 3, 4, and something else going on. So anyway, and in terms of trade setups, again, not for today's session, but there's lots of material we go through. For retracements, that's a breakout maneuver, and all of these green arrows are subsequent retracements. And then onward and upward, you get a secondary breakout from resistance. That's when the election took place, and subsequent pullbacks. So the point of the story is, as we conclude, a little bit after time, focus on the trend. Trend is the most important thing in the world to a trader. Follow the trend and add some other things to it, like accumulation, realization, distribution, maybe not now, but it's certainly either in hyper realization or maybe coming up toward eventual distribution. So cautious at this point, hyper bullish at this point, and so on and so forth for you there. All right, so just as we finish on these, so here's what it is. I think you should work on the third of third concept. Buy on the pullback after your third wave takes place. Sell on the fifth wave. You can use Fibonacci if you want for stops. Advanced extensions kind of play too. Here's the thing, big picture, accumulation, distribution. And use other indicators such as, my favorites, momentum, internals, volume, and as Don mentioned, psychology or sentiment. We talk about pullbacks. It's going to be a little at the little special page for you, premium.afraidtotrade.com/TradeStation. That'll get you a little access to some goodies and some free trial. That's a pullback lesson we talk about. So how we do what we do. And to see this in action, see me actually put my money where my mouth is and forecast stuff for you and do some trades and some education on a private membership basis, I'll give you a free full month. So thank you for your attention and for being part of the TradeStation group. This is great, so I'm happy to be here. But yeah, it's a premium.afraidtotrade.com/TradeStation. And this is what we do with the membership. And if you really want to pick my brain big time, I can be your mentor as a coach. So I have 3 members right now I'm doing, and my maximum is 4. Anyway, but all this is a labor of love. It's fun, interesting, entertaining. Nobody's perfect. The market's not perfect. As traders, we just do the best we can. We learn as much as we can, and we kind of commiserate together, and we learn from each other. So I learn from my members, and they learn from me, hopefully. Tom says, thanks for your excellent educator. Tom's one of my good clients. He was a mentor client as well. So I'm good to see Tom here. Thanks. Yeah, absolutely. If not, questions, Corey at afraidtotrade.com. We're out of time here. Afraid to Trade is a website. Blog is your freebie. We talk about every day. Twitter at Afraid to Trade. And again, your freebie, free month, and some other little goodies for you. Premium.afraidtotrade.com/TradeStation. If I can put that in the chat box. Yeah, there we go. It's in the chat box for you. Again, thank you all for attending. Hopefully, you don't have to use Elliott. If you don't, that's fine. But do put it in context and have fun with the market. Have fun trading, intraday, day trade, swing, invest. We're all in this together. We're all trying to figure this out. So TradeStation is a good reference for you there. Thank you all. My sincerest appreciation. We'll turn back to Don. I'll see y'all Tuesday, by the way.